Olá, seja bem-vindo a mais um podcast de FundsPeople. Uma das questões que se colocam hoje em dia é como encontrar diversificação num cenário de yields baixas e com a inflação a persistir. Para lhe falar sobre este tema, temos connosco o Cristian Balteo. O Cristian é o responsável de produto com um enfoque em multiativos na gestora Nordea Asset Management. E na liderança desta conversa estará João Paulo Silva, que faz parte do Departamento de Desenvolvimento e Marketing do Novobanco. João Paulo, please, go ahead.
Good morning to all, and good morning, Christian, and thank you for being available for this interview. And let's start then with the first question, and very specifically, how is the traditional 60-40 portfolio being challenged by the current market environment?
Of course, Joao. Well, first, let me just thank you and also FundsPeople and everyone who is listening in today. For the invite. It's a pleasure to have the opportunity to get in touch with our Portuguese clients. And I'm very happy to have the opportunity to discuss this topic that I think it's particularly relevant in these days. This is something we have been discussing with our clients already for some years now. There is, as you say, a big challenge for traditional 60-40 portfolios. And one of the main reasons is the fact that expected returns for traditional asset classes are considerably lower for the decade to come compared to what they have been able to deliver over the past 10, 15 years. That is particularly problematic, or that is particularly the case across fixed income assets. Why? Well, because we come from a very strong bull rally in yields, in rates. So yields have continuously been moving down over the past 20 years or so, let's say 15 years maybe. And that, of course, has pushed the historical returns of fixed income assets, particularly highly sensitive to interest rate fixed income assets over these years. But that implies that there is very little room for those to continue to go upwards. On the other hand, credit spreads are also at fairly low level. They have bounced back a little bit over the past couple of months. But in general terms, they are fairly low, and default rates are also extremely low. Now you could say, well, but the fact that default rates are very low should be good for credit. Yes, it's good for credit in the sense that you will not be losing money because of defaults, but that also implies that there's no room for defaults to continue to move down. So defaults as a catalyst for further spread compression have disappeared. So it seems like everything is on the hands of central bank authorities and also on the appetite of investors. If investors want to take risk, then that could push valuations higher and then returns a bit higher. But there is not much more room to go for fixed income assets. So if we think in terms of what is the expected return we could get for European investors in government bonds, say maybe 0.2, 0.3% per annum over the next 10 years. If you think of a German bond, or if you think of a US Treasury hedged to the euro, that's the type of return you're going to get if inflation stays at 2%. If you go into credit, well, the way we look at the world in the multi-asset team, and for those of you who are familiar with Nordea's multi-asset team, you know that we decompose asset classes into the underlying risk factors that explain their return and volatility. So we decompose them in what we call risk premium. If you think of the European high yield or the US high yield benchmark, then of course the return that those benchmarks offer is a decomposition of, or a combination of, the cash rate, the duration, the sensitivity to interest rates, and the credit spread, which is the compensation for the likelihood that issuer will default, right? So duration for us, it's government bond-like, that would come out. And then what we need to be looking at is the credit spread sensitivity, the compensation for the default. Now that credit spread sensitivity offers also fairly low returns going forward, given the low level of spreads we have discussed, maybe around 2% best case scenario. So if you want to generate returns above 2%, which in case, again, inflation goes aligned with the targets of central banks of around 2%, if you want real positive returns, you have to go beyond credit. And what is the next thing?
A big if right now.
Yeah, which is a big if, but we can discuss about that later. The next thing is equities. And equities are probably, in our view, the only asset that will be able to deliver 5% returns per annum going forward along those lines. So if you think in terms of a 60-40 portfolio, 60% equity, so let's say 6 times 5, maybe you'll get around 3% out of your equity return, and then the other 40% of the portfolio in government bonds, then you'll get close to 0% on that. So that means that a 60-40 portfolio from a strategic perspective can give you something like 3.5% per annum. That is extremely low compared to what investors are used to for the amount of risk. Furthermore, there is a diversification issue. So government bonds are not as good as they were historically at diversifying equity risk. So if we think in terms of a 60-40 portfolio, the reason why we have 40% bonds is because when equities sell off, normally it's because the economy is in a recession or there is a risk event like COVID-19 that makes central bank authorities intervene, lower rates, that pushes bond prices up. The problem is that where rates are today, where yields are today, there is very little room for those yields and rates to move much lower. And COVID-19 was a very good example. In February, March 2020, equity sold off 35% from the peak. Treasuries gain around 4%. Bonds remain flat. They rallied a little bit at the beginning, but then they sold off again towards mid-March. So there was no diversification whatsoever. And that is a big problem together with the low expected returns.
Okay. So it looks like the current investment environment is particularly problematic for bonds in general. So does this mean that we as investors should be looking at a portfolio of 100% equity portfolio? Does it make sense?
Well, I mean, don't quote me on that. As you know, we're not in the business of advising clients. And of course, I would tend to say that the best thing investors can do is to reach out to their advisor, which will most likely be able to guide you through on how you should allocate your capital in your investments, in your portfolio of investments. But what you say has some truth.
Let me rephrase it. Of course, yeah. Since the correlation or the decorrelation seems to be not working anymore as well as it did, does it make sense to move? Okay, not 100% equity, of course. That's the extreme, but move away from the 60-40 portfolio to 70-30, 80-20, and so on.
I think it depends. If you have that type of risk profile, if you are willing to sustain a level of volatility above 10%, so maybe 10 to 15% over the full cycle, and much higher levels of volatility during stress market environments, we have seen volatility reaching 30, 50, 80% over the last couple of years for short periods of time. But are you able to wake up tomorrow and find that your portfolio has lost 30% over the last few weeks? If you have the stomach and the risk profile and the liquidity profile to sustain that, maybe that could make some sense. But I would tend to argue that you have to also be careful about, which type of equities you have in your portfolio, right? What are the biases that your portfolio has? Do you have a very clear concentration in high growth stocks that are very sensitive to interest rates? Do you have a very high concentration to value stocks that, in some cases have very little or meager expectations for growth and that lag the market massively between 2016 and 2020? Do you have a lot of IT? Do you have a lot of, sector concentration that it's prone to higher levels of volatility? And there are many things to consider. I would argue that you need to have a more diversified exposure. Then we need to strive to have a more diversified exposure, even within equities, even if you have a high concentration of equities to the portfolio. But I think for most of clients out there, most investors out there, particularly in Europe, they have a more defensive risk profile. They cannot take that high level of volatility, high level of drawn risk. And then I think there are other sources of return they can rely upon, which, probably do not necessarily fall in the space of either equities or bonds, but they're a bit more in the alternative space. But hopefully, I think we will have the time to discuss about that later today.
Yeah, yes, absolutely. But before we move on to alternatives, just one more question. And given that really 100% equity portfolio is really too risky for most investors and doesn't make sense because there are some diversification benefits. But so looking again back into bonds. Does owning government bonds make any sense in the current market environment, or should that 40% part of the portfolio consist only of corporate bonds, or mainly of corporate bonds, being investment grade, be it high yield, or even being emerging market bonds?
To be completely honest, I think that depends quite a lot of what type of fixed income asset we are discussing, and also what else do we have in the portfolio. Again, the way we see it at Nordea's multi-asset team is that we do not look at asset classes as a sole thing, but we try to decompose, why is this asset paying me some return? If an asset is paying me some return, it's because I am getting exposure to certain risks in my portfolio. Okay, how many risks are embedded in that particular asset? And then I would tend to agree that, high quality government bonds, understood as treasuries, bonds, gilts, Australian bonds, Canadian bonds, Swedish bonds, like highly rated AAA countries where there is no credit default premia, let's say embedded, those are a good proxy of interest rate sensitivity. So those bonds should only be moving according to what interest rates do. Does it make sense to have those? Maybe a little bit of treasuries nowadays, maybe a little bit of Australian bonds, but we don't find too much value. As I said, the expected returns are extremely poor, are extremely low going forward. Now, if rates would continue to move higher, then that would be a different story. But where we stay today, I don't think there is a very strong strategic case to hold a sizable amount of high quality government bonds in your portfolio for the next few years. Now, if we think about other type of government bonds with a bit more of credit premium, like Spanish bonds, Italian bonds, Portuguese bonds, emerging bonds, well, then there is a spread component, a credit component. Credit component would be the extra source of risk on top of the interest rate sensitivity that those bonds would have. And that implies there's volatility there, and there should be a compensation for that extra volatility and for that likelihood that that bond could default. The problem that we have with that credit premium at this stage is that it doesn't offer a very high return. Maybe in emerging market sovereign bonds, it is kind of attractive, above 3% or around 3%. For high yield, we would argue that it's around 1.5 to 2%. So it's not that attractive. And investment grade is almost non-existent. But the problem that credit premium has is that it has a very high correlation towards equities when equities are selling off. So when do you need diversification in your portfolio? You need diversification in your portfolio when risky assets, the ones that represent the lion's share of the risk in your portfolio, are selling off. Equities would be those, because those are the ones that have the highest amount of volatility, the highest historical drawdown, and probably expected drawdown. Does credit diversify my portfolio in that environment? No. If we look historically, and we had the case of COVID, that when equities sell off, the correlation, the credit to equities is around 0.8. So they are basically a replica of equities. They are an equity proxy, and their return is much lower. So does it make sense to have equities and credit in the portfolio from a diversification perspective? No. Does credit offer such an attractive risk return as equity does in this environment? No, they don't. So in our view, doesn't make too much sense to allocate to fixed income right now. Now, if you do not own any equities or you own very little equities, then maybe you can diversify with credit, but be aware that the expected return of your portfolio is going to be even lower than what we discussed before at the beginning of our conversation.
Okay. So now turning then to the alternative, i.e. liquid, what we call liquid real assets, like real estate or commodities. And I stress the word liquid, so our exposure to real estate could be through REITs or through equities in companies like Deutsche Wohnen and so on. And of course, our exposure to commodities and would be through the futures contracts and so on. So do they really, it looks like they have a really important, very interesting role to play in a 60-40 diversified portfolio, where we would, for example, REITs would be classified as equities or would be included at 60% equity. So is it true? Do they really represent an alternative, as their name says?
I think that's a very good question, because there is a lot of noise going around about alternative assets in this environment, and I think you hit the bullseye with your first comment, which is we need to separate illiquid real assets or illiquid alternative assets from liquid alternative assets. Illiquid alternative assets are, of course, a good alternative solution for investor, because they offer a liquidity premium, so they offer an extra return for their lack of liquidity, but they are normally only available to institutional clients that first have the minimum ticket to invest. These are not the type of assets you can just go ahead and buy 50,000 euros or 100,000 euros. You need normally millions of euros just to get access to those assets. And also, it has to be said that their alternative nature comes from the fact that they're illiquid. So the reason why they don't sell off when the market sells off is because there is no price on those assets that you can define on a daily basis. So you need to have the stomach to hold your investments for a much longer time and decide today that you want to sell, and maybe wait 1 year until you actually get your money back. And that's not for everyone. So let's leave the liquids one on one side. Now, what about the liquids? And I think that's where your question went ahead. Well, for the liquid assets, they somehow give you a bit of, let's say, diversification. But again, as you clearly said, real estate, liquid, REITs, they are equities. When equities sell off, do they sell off as fast and as strong as equities do? Well, normally they don't. I mean, they did during COVID and a bit even more, but it was because COVID was an exceptional type of, market environment where we actually shut down the economy and were told, go home. So of course, commercial offices were not a very in-demand asset in that particular respect. But historically, if we think of yeah, exactly. So if we think historically in terms of a normal recession, a normal risk-off environment, it is true that real estate, infrastructure, they tend to diversify a little bit. But what they can offer maybe is that they can, give you only 70% exposure to the downside. Maybe they will protect you 20, 30% more than what just buying traditional equities, but they will not give you negative correlation to equities. So they will not be able to, let's say, substantially reduce the drawdown. They might reduce the drawdown slightly, at least if you go to this type of alternative assets via long-only strategies. Now, if you have some type of long-short strategy that tries to somehow exploit that premium, then that could be different. But you also need to be prepared for the environment where, the market goes up, the economy is doing well, and real estate and infrastructure lag the market, as it is normally the case during very strong bull markets, right? So there are two sides of that coin. Commodities are a different thing. Depending which commodity are we talking about? There are some commodities that have a lot of cyclicality, right? They're very sensitive to the economic cycle. If the economic cycle is doing well, they will boom. If the economic cycle is doing bad, they will come down. So do I get diversification from something that it's called commodities instead of equities just because it has a different name? Or should I drill down and look about the conditional correlations? Look at the behavior. How does this asset perform when equities are selling off? That is the key of the question. The key of the question is not how things are called, to which asset class they belong, how are they traded. It's about how do they behave in tail market environments. Tail market environments understood as very stressed market environments, because it's in those environments where you want diversification and the correlation towards equities. When equities are going up, I'm fine if everything correlates to equities. It means I'm going to gain money on everything I have in my portfolio. So I think these type of alternative assets, there are liquid, offer some little diversification, but they are not the final solution in terms of diversification.
Yeah, and especially because it's a very heterogeneous, let's say, investment class or asset class. And even within the subclass commodities, because they are, like precious metals, industrial metals, agricultural commodities, and so on.
Correct.
Energy, and they all behave differently from each other.
I mean, gold could be a good diversifier. There are many managers out there that use gold as a diversifier. We normally do not use gold because when an asset does not have cash flows, how do you value it, right? It's very hard to put a fair price into something that does not give you cash flows. And we would tend to argue that, as we cannot put a price on gold, and we run into the risk that we might buy gold when it's very expensive. And when gold is very expensive, or in general, when assets are expensive, their ability to protect you from a recession or from a sell-off market environment is considerably lower. So as we cannot put a price into gold, even if from a fundamental perspective, gold should be a safe haven type of asset, we would look at it with a bit more cautious. We'd rather use other type of alternative strategies where we can apply this fundamental overlay to put a price on it and just buy those that are a bit more attractive.
One final question about alternatives. Usually, or sometimes, they're still a little bit equated with, hedge funds and let's call it non-UCITS funds. But do we have to go that way to invest in alternatives, or is the UCITS universe really, or especially for private investors or retail investors, is this a very, very reasonable alternative to stay within the UCITS universe when investing in alternative investments?
Yeah, I think historically it is somehow true that liquid alternative strategies or hedge fund strategies were very opaque, and they also have very high costs, and they are not regulated, so you're prone to some risks that you do not have in the UCITS setup. They also tend to be much more illiquid, but as the regulation and the industry has evolved over the past couple of decades, we do now have the ability to offer wholesale and retail clients access to very sophisticated liquid alternative strategies within the UCITS setup. So highly regulated, daily liquidity, no performance fee, no lock-in period. So it's not like if you invest, you need to commit to stay for 3 years. You invest today, tomorrow you can divest. You invest today, 3 days later, you have the assets, the funds in your account. You sell today, 3 days later, you have the cash back in your account. So there are now strategies available via the UCITS setup that can bring that diversification to clients, what we call liquid alternatives. In Nordea, we have a very long experience managing those. We have what we call our alpha strategies, alpha MA strategies, which have different risk profiles, and where we have an extra focus on liquidity, because we think one of the most important risks for wholesale clients is liquidity. Again, if you think in terms of COVID-19 sell-off in February, March 2020, 80% of the questions we were getting from clients were not, why are funds struggling? Because actually our liquid alternatives did very well. They had an initial sell-off, but they recovered quite fast. But they were saying, how fast could you liquidate your portfolio? If I sell now, how long will it take me to get my money? And even in those very stressed market environments, we were able to, liquidate more than 90% of the portfolio in a single day. And that speaks quite high about the ability that we have in terms of liquidity, and also the type of assets that we use to deliver these alternative value propositions. But I think in general terms, besides the fact that they are in the UCITS format and that they follow this close regulation and they are controlled by regulators here in Luxembourg, but also across Europe, and the fact that they offer high liquidity, the outcome is what is really attractive, because liquid alternatives are unconstrained solutions, absolute return solutions that have the ability to, at least in theoretical terms, to deliver a positive return even when all assets are selling off. So again, if we move to an environment where you say correlations between equities and bonds are broken, liquid alternatives have the tools to deliver positive returns when both equities and bonds are selling off. Now, do all liquid alternative funds deliver positive return in that environment? No. Do our liquid alternative solutions are able to deliver positive return every time bonds and equities sell off? No. But if we look at the very long term, at least for those managers that have been very successful with liquid alternatives, and we would like to think that we are among those, we have been able to deliver, I would say, a very good value propositions in terms of positive convexity. What does positive convexity means? It means that these strategies, particularly the alpha strategies that we have, they aim to capture a sizable amount of the bull markets. For example, if we look at the last 10 years, we can capture maybe 75, 50, 35% of the bull markets. But whenever equities are selling off, we aim at neutralizing the impact in the portfolio. So returns that are close to zero when markets are selling off, and maybe half, a third of the bull market when markets are going up. And that applies when equities are selling off, but that also applies when bonds are selling off. So when bonds are selling off, some of these liquid alternative strategies, they should be able to deliver positive returns when bonds are doing well, but also to protect you when bonds are doing bad. So I think from a diversification perspective, as an alternative to the traditional 60-40 portfolio, liquid alternatives could be a very important part of investors' portfolio. Again, I am not in the business of investment advising. I think all investors need to have an advisor, a professional advisor that can recommend them what they can or cannot do and should not do. But I think right now is one of those points in time when we need to rethink the way we build portfolios, rethink the way we invest, because the traditional way of doing it is really facing some clear headwinds.
And we are not in a traditional investment, let's say, environment. So of course we have to think outside the box, if you will. And to wrap it up, how do you see multi-asset investment, diversified investment, 60-40 or investment in 2002? What promises to be a very challenging but also very interesting investment year.
Yeah, I think for 2022, the question on every investor's mind is, where is inflation heading? Will we continue to have high inflation? Will inflation come down? We do not necessarily have the answer to that, right? We're not in the macro call business. We're not top-down managers, so we do not have a clear view of what's going to happen with inflation. What we would say is that it seems that the spike in inflation we have seen, it's very much COVID-driven. Why? Because COVID generated both a shock on supply and demand. On demand, because if we were not allowed to go out or travel or going to the movie theater or going to a restaurant, we were not going to be able to consume services. But we still like to buy stuff, right? We have a consumption problem in modern society. So what did we do? We started buying more goods, right? And most of those goods had some kind of microchip component in them, like, gadgets. So that severely changed the demand, and that pushed prices of goods up while services remained depressed. In the meantime, we also were into lockdowns, right? Not only lockdowns for consumers, but also lockdowns for workers. So if you have a plant where you're producing microprocessors and you have to go into lockdown, then you don't produce any more microchips, right? So that creates an issue in these global integrated value chains where you have a component made in Taiwan, one made in Vietnam, one made in China, one made in Korea, and that is put into a phone somewhere in let's say China also, and then it's shipped to the US where we would buy it. That created a lack of supply of some of those assets, and we're still seeing that, for example, in the car industry, where if you go now to buy one of these new electric cars that have a lot of microchips components, you probably have to wait like a year to get it. So that changes supply and the demand. Now, it seems so that now that we are going through this phase where might be that COVID becomes endemic and we have high vaccination rates, at least in developed markets, the demand pattern would change, right? We can now start traveling again, maybe, and going to restaurants and going to concerts and just, going to the movie theaters and, whatever. But the supply side still remains a question. Why? It's not like we have not delivered microchips. Yes, the growth in production and sales of microchips has been quite outstanding. But first, you need to install further capacity for the higher demand. And second, in certain regions of the world that are very much important for these global value chains, like China, they still have a zero COVID policy, which means they're not, as of today, with the idea to let this virus become endemic. They are still willing to treat it as a pandemic. So they will go into strict lockdowns if they have a spike in cases. And that might create an issue for supply of these components and global supply integrated value chains. So it's not so sure if we are going to see inflation coming down as bond markets have been pricing and as central banks have let us know. So what would happen if inflation, instead of averaging 2% over the next 5 years, which is what central banks expect, it's 3%? That's going to be very bad for government bonds. So we were talking before about the fact that government bonds offer returns that are very close to zero and they were not attractive at all. Well, if inflation is higher, then that's even worse for government bonds. But what about equities? Well, equities, the story is a bit different, right? Because if we look at 2021, which was the first year in decades where we had an inflation issue, companies were able to say very positive earnings revisions throughout the whole year and very strong increases to historical maximums of both gross and operating margins. If we look at a longer term, we have seen data in the US since 1954. There seems to be a very positive correlation between earnings growth and inflation. So historically, that hasn't been an issue. If we look at global equities, not only S&P, and we look at the last 25 years that we have data, it seems that there is also a positive correlation between earnings growth and inflation. There's also a positive correlation between earnings growth and even valuations, which you would not expect. And that seems to be the case for equity markets in general, but it also seems to be the case for value stocks, and it seems to be the case even for growth stocks, which are the ones that would struggle more if interest rates move upwards. Now, what about one of our favorite style biases in equities, low risk equities? Well, for those, we went back to the 70s and the 80s, which was the last period when we had very high inflation. And we saw real earnings of those high quality consumer staple type of equities that historically could be considered as low risk stable equities and that we still tend to like to have in our portfolio. And their earnings, the real earnings growth was very positive. So they grew their earnings at a much faster pace than CPI. So again, it's very important that yes, equities are the favorite asset to have now because of higher expected returns, because their ability to withstand inflation, but you also need to be mindful of which equities would protect you better. And that, of course, for that, you need an active manager that has a lot of experience in the liquid alternative space. And of course, we hope that somehow Nordea is in your short list of managers to consider if that would be the case.
And plus some very high quality equities also traditionally are high paying dividend equities, which would be an alternative to bonds, which are traditionally the yielding part of the 60-40 portfolio.
Of course, I think investors need to pay a very close attention on how stable are the earnings growth and the dividend yield of the companies they buy in. We tend to favor companies that have very stable development of earnings and dividend yield growth, because again, dividends of very defensive stocks, they tend to work as the coupon of a bond, as you clearly say. So they could be the replacement for those that can take higher risk because there is higher volatility on those equities, of course. But also that you can look into long short strategies that buy those stocks on the long arm and maybe sell the market to try to exploit that higher dividend yield premium, that carry premium, and also the stability premium, if there is such a thing as an stability premium, which in the academic research, they refer to as low risk or minimum volatility. So yeah, we tend to favor those, and I would agree with you that that makes a lot of sense going forward.
Okay, well, thank you very much, Cristian, and for this, those very interesting insights, and thank you for FundsPeople for giving us the opportunity to chat about investment in 2022.
No, thank you very much to you, João. It's been a great opportunity, and thank all of those that were listening today, and also to FundsPeople for the organization, and hope to see you guys in Portugal soon. Thank you.
Yes, absolutely.